Before we dive in, please remember that I am not a licensed financial advisor, mortgage broker, or real estate professional. The information provided in this video is for educational and informational purposes only and should not be considered financial, legal, or tax advice. Buying a home is one of the biggest financial decisions you'll ever make, so please consult with qualified professionals before making any decisions based on the content of this presentation. You've spent months, maybe even years scrolling, late nights on Zillow, Redfin, Realtor.com. You've created dream boards. You've driven through neighborhoods you'd love to live in, and then you find it. The one. The house with the perfect backyard for a dog you don't even have yet. The kitchen with the island where you can already picture holiday dinners. The walk-in closet that finally has enough space. A surge of excitement hits you. This is it. You're ready. But then you click the button that says, Get pre-qualified. And you fall down a rabbit hole of terror. Suddenly, you're staring at a wall of acronyms and financial jargon that feels like a foreign language. DTI, LTV, PMI, escrow, points. Your excitement turns to anxiety. Your dream starts to feel impossible. You start to think, maybe I'm not ready. Maybe I don't have what it takes. That feeling, that overwhelming sense of confusion and doubt, is the single biggest barrier standing between millions of Americans and the keys to their own front door. And here's the secret the mortgage industry doesn't want you to know. It's designed to be confusing. They benefit when you don't know the rules of the game. Well, today the game changes. This isn't just another video listing a few tips. This is a complete, 10-part masterclass designed to turn you from a nervous applicant into a confident, prepared homebuyer. We are going to rip back the curtain on the entire mortgage process piece by piece. We're going to demystify the jargon, expose the myths, and give you a rock-solid step-by-step blueprint. By the end of this series, you won't just know what you need to get a mortgage. You will know how to get the best mortgage possible for your situation. You will walk into a lender's office or fill out an online application with the unshakable confidence of someone who knows exactly what they're doing. So where do we start? We start by building a foundation. Getting a mortgage isn't one single event. It's about proving your strength in 5 key areas. Think of these as the 5 pillars of mortgage readiness. Everything a lender looks at, every document they ask for, every question they ask falls into one of these 5 categories. Pillar number 1, your credit. Pillar number 2, your income. Pillar number 3, your assets. Pillar number 4, your debt. And pillar number 5, the property itself. Get these 5 pillars right and the entire process becomes 10 times easier. Get them wrong, and you're in for a world of stress and possible rejection. In this first part, we are going to do a deep dive into the undisputed king of the 5 pillars, your credit. Why is credit king? Because it's the fastest way for a lender to get a snapshot of your financial character. It's their crystal ball. Your credit report tells a story about your history with debt. Do you pay your bills on time? Do you live within your means? Are you reliable? Before a lender is willing to hand you hundreds of thousands of dollars, they want to see your financial report card. And that report card is your credit score. Now, the first thing you need to understand is that you don't just have one credit score. You have dozens. You've probably seen your score on apps like Credit Karma or from your credit card company. These are typically Vantage scores, and they are fantastic educational tools for monitoring your credit. But here's a critical piece of information. The vast majority of mortgage lenders do not use that score. For mortgages, lenders almost exclusively use FICO scores. Specifically, they use older, more mortgage-specific versions of the FICO model. This is why the score you see on a free app can sometimes be 20, 30, or even 50 points different from the score your mortgage lender pulls. It's not a mistake. They're simply reading from a different playbook. So what's the magic number? What FICO score do you actually need? While rules can change, for most conventional loans, the bare minimum score you'll need is a 620. Let me repeat that. A 620 FICO score is generally the floor. Getting a loan below that number is incredibly difficult. But here's the reality check. A 620 score doesn't get you a good deal. It gets you in the door, but you'll be paying a significantly higher interest rate and potentially higher fees, costing you tens of thousands of dollars over the life of the loan. The sweet spot, the number where you start getting access to the best interest rates and lower costs, is 740 or higher. If your score is 740, 760, 780, or above, lenders see you as a prime borrower. You are low risk. They will compete for your business. offering you their most attractive loan products. Your goal should not be to just squeak by with a 620. Your goal should be to climb as high above 740 as you possibly can. Now, here's another inside secret about how lenders use these scores. They will pull your credit report from all three major credit bureaus: Experian, Equifax, and TransUnion. You will have a different FICO score from each bureau because not all of your creditors report to all three. So which score do they use? Do they average them? Do they take the highest? No, they take the middle one. This is called your tri-merge report, and they will use your middle qualifying score. For example, if your scores are 720, 750, and 765, the lender will ignore the lowest and the highest and use the 750 to determine your eligibility and your interest rate. If you're applying with a spouse or partner, they will pull both of your reports, identify both of your middle scores, and then use the lower of those two scores. This is a crucial point. It doesn't matter if one of you has an 800 credit score. If the other has a 630, your application will be judged based on that 630. So what's your first action item? Your first step on this journey is to find out exactly where you stand, and you need to see what the lenders see. You can get a free copy of your full credit report, not just the score but the entire report, from each of the three bureaus once a year at annualcreditreport.com. That is the official government-mandated site. When you get these reports, you are going on a treasure hunt. You're looking for three things. First, errors. Is there an account on there you don't recognize? Is a late payment listed that you know you paid on time? Is a debt showing as open that you paid off years ago? 1 in 5 Americans has an error on their credit report, and disputing and removing these errors can be one of the fastest ways to boost your score. Second, you're looking for negative items, specifically collections accounts and charge-offs. These are poison to a mortgage application. A single recent unpaid collection account, even for a small amount, can get your entire application denied at the last minute. Identifying these now gives you time to address them. And third, you're looking at your credit utilization. This is the percentage of your available credit that you are currently using on your credit cards. If you have a card with a $10,000 limit and a $5,000 balance, your utilization is 50%. For a top-tier credit score, you want to keep your overall utilization below 30% and ideally below 10%. High balances, even if you pay them on time, can dramatically drag down your score. Understanding your credit is the non-negotiable first step. It dictates your interest rate, your monthly payment, and in many cases whether you get approved at all. It is the bedrock of your entire mortgage application. Pull your reports. Analyze them line by line. Know your numbers. Because in the next part we're going to build on this foundation and move to the second pillar, your income. And I'm going to show you exactly how lenders look at your paycheck and how to prove you have the financial horsepower to handle a mortgage payment. So how much financial horsepower do you actually need? And more importantly, how do you prove it to a lender who has never met you? Because in their world, your income isn't just a number. It's a story. It's the story of your stability, your reliability, and your ability to consistently handle the single biggest monthly payment you'll likely ever have. To understand this story, lenders use one primary tool. It's a simple ratio, but it is the absolute king of mortgage qualification. It's called your debt-to-income ratio, or DTI. Get this number right, and the doors to homeownership swing wide open. Get it wrong, and you'll be hitting a brick wall no matter how much you think you make. Here's how it works, and I want you to do this math with me right now. First, add up all of your monthly debt payments. I'm talking about the minimum payments on your credit cards, your car loan, your student loans, any personal loans. If you're paying child support or alimony, add that in too. Now here's what you don't include: your rent, your utilities, your cell phone bill, your groceries, your gas. Lenders don't count those day-to-day living expenses. They are only looking at your fixed, contractual debts that show up on your credit report. Let's say all those debts add up to $1,500 a month. Next, you need your gross monthly income. This is a huge point of confusion. We're not talking about your take-home pay after taxes and insurance. We are talking about your total pre-tax salary. So if you make $60,000 a year, your gross monthly income is $5,000. Now, you divide the debt by the income. In our example, that's $1,500 in debt divided by $5,000 in income. That gives you 0.30, or a DTI of 30%. That number, 30%, tells a lender how much of your monthly income is already spoken for before you even pay for your new house. Now, when we add the new mortgage payment into this equation, That's when the real test begins. Let's say your new, all-in mortgage payment, that's principal, interest, taxes, and insurance, is going to be $2,000. We add that to your existing $1,500 of debt. Your new total monthly debt is now $3,500. We divide that by your $5,000 gross income. Your new DTI is 70%. And at that number you will be denied 100% of the time. So what's the magic number? For decades, the gold standard was something called the 28 of 36 rule. It meant your new housing payment couldn't be more than 28% of your gross income, and your total debt, including the house, couldn't be more than 36%. But times have changed. Today, for most conventional loans, lenders are looking for a total DTI of 43% or less. That's the line in the sand drawn by the government after the 2008 crash. It's considered the highest ratio a borrower can have and still be reasonably expected to make their payments. Can you go higher? Sometimes. With a large down payment, fantastic credit, and cash reserves, some loan programs might stretch to 45%, 47%, or even 50%. But think of 43% as your target. If you're under that, you're in the game. But here's the thing. The DTI calculation is simple, proving the income part of that equation. That's where the story gets complicated. How you prove your income depends entirely on how you earn it. Let's imagine two people. First, we have W-2 Wendy. Wendy works a salary job in marketing. She gets a regular paycheck every 2 weeks from the same employer she's been with for 5 years. For the lender, Wendy is a dream come true. Her income is stable, predictable, and incredibly easy to verify. All Wendy needs to provide are her last 2 pay stubs, her last 2 W-2s, and maybe a quick call to her HR department to confirm she still works there. The lender can look at her W-2, see she made $70,000 last year, see she made $68,000 the year before, and they can say with near certainty, Wendy's income is stable and likely to continue. Her path is smooth and straightforward. Now let's meet self-employed Sam. Sam is a freelance graphic designer and a fantastic one at that. Last year, he billed $120,000. He makes way more than Wendy. But when Sam goes to get a mortgage, he's in for a rude awakening. The lender doesn't care that he billed $120,000. They care about what he claimed as profit on his tax returns. And this is the great paradox of being self-employed. You spend all year trying to find every possible deduction to lower your taxable income. You write off a portion of your home, your new computer, your cell phone bill, your mileage, your business lunches. You're a genius at tax time. You took that $120,000 gross and, after $50,000 in legitimate business expenses, you told the IRS you only made $70,000. Well, guess what? You just told the mortgage lender you only made $70,000 too. You can't have it both ways. Furthermore, the lender is going to ask Sam for his last 2 full years of tax returns. They want to see a history. If he made $70,000 in profit last year, but only $30,000 the year before, they're not just going to give him credit for $70,000. They're going to average the two. So in their eyes, Sam's qualifying income is only $50,000 a year, or just over $4,000 a month. Sam's massive, 6-figure business has suddenly shrunk to less than Wendy's W-2 salary in the eyes of the underwriter. This applies to anyone who gets a 1099, runs a small business, or is part of the gig economy. The rule is almost always 2 years of tax returns, and they will use your net income after expenses, not your gross revenue. What about other types of income? What if you get a big annual bonus? Or you work a ton of overtime? Or you rely on sales commissions? A lender will never ever count a one-time bonus. They see it as a fluke. To use that income for qualifying, you need to show a 2-year history of receiving it, and they will likely average it out. If you got a $20,000 bonus last year but only $5,000 the year before, they're not going to use $20,000. They'll average it to $12,500 for the year and add that to your base salary. They are always looking for a stable, predictable pattern. The same goes for part-time work. You can absolutely use income from a second job, but you need to have been working it for about 2 years to prove it's not just a temporary gig you picked up to try and qualify for a loan. This principle of stability extends to everything. Child support or alimony. You'll need a copy of the divorce decree, and you'll have to prove you've been receiving it consistently for at least 6 months, and that it's scheduled to continue for at least 3 more years. Income from a rental property? You'll need a signed lease agreement, and you'll likely only get to use about 75% of the rental income, because the lender automatically assumes 25% will go toward vacancies and repairs. So what's the lesson here? Your income isn't just a number. It's a track record. The single biggest mistake people make is assuming that the money hitting their bank account is the same number the lender will use. It rarely is. If you are a W-2 employee, your job is simple. Maintain stability. Don't go switching jobs from a salaried position to a commission-only sales gig 3 months before you apply for a loan. Even if the new job has higher potential, the lender will see it as a massive risk and will likely make you wait a year or two to establish a track record. And if you are self-employed, the most important advice I can give you is this: plan ahead. Talk to a mortgage lender before you file your taxes. It might be worth paying a few $1,000s more in taxes this year if it means your qualifying income is $20,000 higher, allowing you to buy the house you actually want. You need to stop thinking like a taxpayer and start thinking like a borrower, at least for the 2 years leading up to your purchase. Okay, so you've proven you have the credit and you've documented your income. Your DTI is in line. You're almost there. But the bank has one more crucial question, and it's the one that trips up so many hopeful buyers. Show me the money. Not just the money you earn, but the money you have. In the next part, we're diving deep into the world of assets, down payments, and closing costs. And I'll reveal the number one mistake people make with their bank accounts that gets their loan application denied on the spot. So let's talk about that bank account, because while lenders are obsessed with your debt, they are just as obsessed with your cash. This is the second major pillar of your mortgage application: your assets. Assets are just a fancy word for the money and investments you have. We're talking about your checking and savings accounts, stocks, bonds, mutual funds, your 401k, your IRA. This is your financial firepower. The lender needs to see two specific things from your assets: that you have enough for a down payment and closing costs, and that you'll have money left over after you close. This leftover money is called your reserves, and it's one of the most overlooked parts of the mortgage process. Think of it like this: a lender doesn't want to give you the keys to a $300,000 house if you're going to have exactly $0 left in your bank account the next day. What happens if the water heater breaks a week later, or you lose your job a month later? They want to see that you have a cushion, a safety net. Typically, they want to see that you have enough in reserves to cover a few months of your total mortgage payment. That's principal, interest, taxes, and insurance. It's their proof that you're not just scraping by, but that you're financially stable enough to handle the responsibilities of homeownership. Now let's get to the big one, the number that stops most people dead in their tracks before they even start: the down payment. For decades, we've had it drilled into our heads that you need 20% down to buy a house. If you want a $400,000 house, you need $80,000 in cash. For most people, that's an impossible mountain to climb. But here's the truth: the 20% rule is one of the biggest myths in real estate today. It's a great goal, but it is absolutely not a requirement. Let's break down the reality. There are government-backed loans designed specifically to make homeownership more accessible. An FHA loan, which is insured by the Federal Housing Administration, allows you to put down as little as 3.5%. On that same $400,000 house, that's $14,000, not $80,000. That's a world of difference. For military members, veterans, and eligible surviving spouses, a VA loan often requires 0% down. Nothing. Same for a USDA loan if you're buying in a qualifying rural area. Even conventional loans, the ones that aren't government-backed, have options for as little as 3 to 5% down, especially for first-time homebuyers. So why does everyone talk about 20%? It's because putting 20% down allows you to avoid something called PMI, or private mortgage insurance. PMI is an extra fee added to your monthly mortgage payment. It doesn't protect you. It protects the lender. If you put down less than 20%, the lender sees you as a slightly higher risk. So, they force you to pay for an insurance policy that pays them back if you stop making your payments. It can add hundreds of dollars to your monthly bill. And it's money that does absolutely nothing to build your own equity. Once you reach 20% equity in your home, you can typically request to have the PMI removed. So putting down 20% from the start just lets you skip that entire expense. It's a fantastic financial move if you can do it, but it is not a barrier to entry. Don't let the myth of 20% stop you from exploring your options. But the down payment isn't the only cash you need. There's another hurdle that trips up almost every first-time buyer: closing costs. This is the silent killer of home buying budgets. Closing costs are the collection of fees you have to pay to finalize the mortgage. They're separate from your down payment and are typically between 2 and 5% of the home's purchase price. So on that $400,000 house, you need to be prepared for an extra $8,000 to $20,000 on top of your down payment. What are you even paying for? It's a whole list of things. The loan origination fee, which is what the lender charges for creating the loan. The appraisal fee, to have a professional confirm the house is worth what you're paying. Title insurance, which protects you and the lender from any ownership claims on the property from the past. Attorney fees, inspection fees, the cost of recording the deed with the county, and prepaying for your property taxes and homeowner's insurance. It adds up, and it adds up fast. The good news is that you can sometimes negotiate for the seller to pay a portion of these costs, but you can't rely on it. You have to go into the process with your eyes wide open, knowing you need one pile of money for the down payment and another separate pile of money for closing costs. Okay, so you've saved your money. It's sitting in your bank account ready to go. You've avoided the myth of the 20% down payment, and you're prepared for closing costs. You're ready, right? This brings us to the number one mistake I see people make. The one thing that gets a perfectly good loan application thrown straight into the rejection pile. It's called unsourced funds. Let me tell you a quick story about a client I'll call Mark. Mark was a waiter. He was incredible at his job and saved up over $15,000 in cash tips over 2 years. He kept it in a safe at home. 2 months before he applied for a mortgage, he walked into his bank and deposited the entire $15,000 into his savings account. He thought he was doing the right thing, showing the lender he had the cash. But when the underwriter reviewed his bank statements, they saw a normal account with a few $1,000s, and then suddenly a massive $15,000 deposit out of nowhere. To the underwriter, this is a giant red flag. Why? Because they have to be able to source and document every single dollar you're using for the transaction. Their first thought isn't, oh, he must have saved cash. Their first thought is this an undocumented loan? Maybe his parents gave him the money, but instead of properly documenting it as a gift, he's trying to pass it off as his own. A secret loan is a secret debt, which completely changes your debt-to-income ratio. Or worse, their minds can go to illegal activities. The Patriot Act has strict rules for banks to prevent money laundering. A large unexplained cash deposit makes them slam on the brakes. The bank asked Mark to prove where that $15,000 came from. But how do you prove 2 years of cash tips? He didn't have pay stubs for it. He didn't have a paper trail. His application was denied. It was heartbreaking. Here is the critical lesson. Any money you plan to use for your down payment or closing costs needs to be seasoned. That means it needs to sit in your bank account for at least 60 days. Long enough to show up on 2 consecutive monthly bank statements. When the money has been there for that long, the bank considers it your asset, no questions asked. If you have cash at home, mattress money, deposit it into your account months before you plan to start house hunting. Let it season. If a family member is giving you money as a gift, don't just have them Venmo you $10,000. You need to get a formal gift letter, a document where they state the money is a true gift and not a loan that needs to be repaid. Your loan officer will give you a template for this. Lenders are not detectives. They are auditors. They don't want to solve mysteries. They want to see a clear, clean, and boring paper trail that shows exactly where your money came from and proves that it's yours. Don't make a marked mistake. Be transparent. Document everything. And season your funds. So now you understand the 2 financial pillars, your income and your assets. You know what lenders are looking for, and you know the biggest pitfalls to avoid. But a mortgage application is more than just your finances. It's about you. It's about your history. In the next part, we're going to tackle the most feared number in all of finance, your credit score. We'll break down exactly what that 3-digit number means, how lenders use it to decide your fate, and I'll reveal the minimum score you actually need to get your foot in the door. It's probably lower than you think. So what is that magic number? What is the real minimum credit score you need to get a mortgage? The answer is a bit more complicated and a lot more interesting than a single number. Because your credit score isn't just a number. It's the story of your financial life, condensed into 3 digits. It's your financial reputation, the grade on your adulting report card. And when you ask a bank for hundreds of thousands of dollars, you better believe they're going to read that story very, very carefully. To a lender, you are a risk. That sounds harsh, but it's the truth. They're about to make the single biggest investment of their life in you. Your credit score is their primary tool for measuring that risk. It's a predictive score designed by a company called FICO, the Fair Isaac Corporation, to guess the likelihood that you will make your payments on time for the next 30 years. Now, you've probably seen your score on a free app or your credit card statement. That's usually a Vantage score, which is helpful for a general idea. But when it comes to mortgages, FICO is the king. It's the industry standard. Lenders will typically pull your FICO score from all three major credit bureaus, Experian, Equifax, and TransUnion, and they'll usually use the middle score of the three for their decision. So how do they come up with this number? What are they actually looking at? It's not a mystery. FICO is transparent about the 5 key ingredients that make up your score. Understanding these is the first step to mastering your financial destiny. The first, and by far the most important ingredient, making up a massive 35% of your score, is your payment history. This is the foundation of everything. Do you pay your bills on time? Every time? That's it. It's that simple and that brutal. A single 30-day late payment can drop an excellent credit score by over 100 points and stay on your report for 7 years. It's like a giant flashing neon sign to lenders that says, "I might not pay you back." Conversely, a long history of on-time payments without a single blemish tells them you are reliable. You are a safe bet. The second biggest piece of the puzzle, at 30%, is called amounts owed, but what it really means is your credit utilization. This sounds complicated, but it's just the ratio of how much you owe on your credit cards compared to your total credit limit. Imagine your total credit limit is a bucket. Lenders don't want to see that bucket filled to the brim. If you have a $10,000 credit limit across all your cards and you have a $9,000 balance, you're at 90% utilization. That looks risky. It suggests you're living on the edge, relying on credit to get by. Ideally, you want to keep your utilization below 30%, and for the best scores below 10%. It shows you have credit available, but you don't need to use it. It shows you're in control. Next up, at 15%, is the length of your credit history. This is the test of time. Lenders want to see a long, established track record. The score considers the age of your oldest account, your newest account, and the average age of all your accounts. This is why the advice to never close your oldest credit card is so golden. That old no-fee card you got in college? It's a pillar of your credit history. Closing it is like tearing out the first chapter of your financial story, making your entire history look shorter and less established. The final two ingredients are smaller, but they still matter. 10% of your score is your credit mix. Lenders like to see that you can successfully manage different types of credit. For example, a mix of revolving credit, like credit cards, and installment loans, like a car loan or a student loan, shows you're a versatile and responsible borrower. It's not a deal breaker, but it helps. And the last 10% is new credit. This looks at how many new accounts you've recently opened and how many hard inquiries are on your report. A hard inquiry is when a lender pulls your credit to make a lending decision. 1 or 2 here and there is fine. But if you apply for 5 different credit cards and 2 car loans in a single month, it sends up a huge red flag. To a lender, it looks like you're desperate for cash, and that makes you a much bigger risk. So payment history, amounts owed, length of history, credit mix, and new credit. That's the recipe. That's what creates your 3-digit financial story. Now let's get back to the big question. What is the minimum score you actually need? For a conventional loan, the most common type of mortgage, most lenders are looking for a minimum FICO score of 620. If your score is 619, the computer often says no automatically. 620 is the entry ticket. But here's where it gets interesting. For an FHA loan, which is backed by the government and designed to help first-time homebuyers, the rules are different. The Federal Housing Administration allows for scores as low as 580, provided you can make a 3.5% down payment. And if you can put down 10%, the official FHA minimum drops all the way down to 500. 500. That is significantly lower than most people think. For other government-backed loans, like a VA loan for veterans or a USDA loan for rural areas, there's often no official minimum credit score set by the government at all. However, the private lenders who actually issue these loans will have their own internal requirements, called overlays, which usually bring the practical minimum back up to around the 620 to 640 range. So, yes, it is technically possible to get a mortgage with a credit score in the 500s. You can get your foot in the door. But I need you to understand something, and this is the most important part of this entire discussion. Getting approved with the minimum score is not a victory. It's a trap. Think of it like this. A 620 score doesn't tell a lender you're a great borrower. It tells them you are the absolute riskiest person they are legally allowed to give a loan to, and they will charge you a premium for that risk. A massive premium. The interest rate you are offered on your mortgage is directly tied to your credit score. A higher score means less risk, which means a lower interest rate. A lower score means more risk, which means a much higher interest rate. And the difference isn't trivial. We're talking about a financial impact that can change the course of your life. Let's run the numbers. Say you're buying a home with a $400,000 mortgage. If you have an excellent 760 credit score, you might qualify for an interest rate of, let's say, 6.5%. Your monthly principal and interest payment would be about $2,500. Now, let's say your friend applies for the exact same loan, but they have a 630 credit score. They barely squeaked by. The bank might approve them, but at an interest rate of 7.5%. That 1 percentage point difference doesn't sound like much, does it? But their monthly payment is now over $2,800. That's $300 more. Every single month. That's $3,600 a year. Enough for a great vacation, or a serious boost to your retirement savings. But it gets so much worse. Over the 30-year life of the loan, that 1 percentage point difference means the person with the lower credit score will pay over $108,000 more in interest for the exact same house. $108,000. That's a college education. It's a fleet of new cars. It's a life-changing amount of money, vanished into thin air. All because of that 3-digit number. Your credit score isn't just a gatekeeper that lets you in or keeps you out. It's a price tag. It determines the price you will pay for the privilege of borrowing money. The minimum score gets you in the door, but the best scores get you the keys to the kingdom, saving you a fortune and putting you on the fast track to building real wealth. So you understand what the score is, and you know why it's arguably the most important number in your financial life. But how do you actually find out your real FICO score? The one the mortgage lenders see, not the watered-down version on your banking app. And more importantly, what if your score isn't where it needs to be? In the next part, we're going on a mission. I'm going to show you exactly where to get your mortgage-ready credit report for free, and we'll start dissecting it line by line to find the hidden opportunities and the silent score killers that could be costing you a fortune. Our mission begins now. The first step in any intelligence operation is gathering the intel, and your most critical piece of intel is your credit report. Not the fuzzy score you get from a free app, but the raw, detailed dossier that lenders will see. The one that holds the key to unlocking that mortgage. So where do you get it? Forget the flashy commercials and the websites that demand your credit card for a free trial. There is only one place you need to go. It's a website mandated by federal law, designed specifically for you, the consumer. Write this down, bookmark it, tattoo it on your arm if you have to. Annualcreditreport.com. That's it. No .org, no .net. Just annualcreditreport.com. This is the official government-sanctioned source where you are entitled to a free copy of your credit report from each of the 3 major bureaus, Equifax, Experian, and TransUnion, every single week. Yes, weekly. It used to be yearly, but they changed the law. This is your right. Claim it. Why all 3? Because they don't talk to each other as much as you think. A creditor might only report to 1 or 2 of them. An error might exist on your Experian report that doesn't show up on your TransUnion. A lender will almost always pull a tri-merge report, meaning they look at all 3 and often use the middle score of the 3 to qualify you. If one of those reports is damaged by an error you didn't know about, that's the one that could sink your entire application. We leave no stone unturned. We gather all the intel. So go to the site, follow the steps. You'll have to answer some security questions to prove you are who you say you are, and download all 3 reports as PDFs. Save them. This is your financial blueprint. Now let's open one up. It doesn't matter which one you start with. At first glance, it looks like a boring, confusing mess of numbers and codes. But it's not. This is a story. It's the financial story of your adult life. And we are about to become expert interpreters. The first section is the easiest. Personal information. Your name, address, social security number, date of birth. You're thinking, yeah, I know my own name. Don't skip this. I want you to scrutinize it like a detective. Do you see any addresses you don't recognize? Any variations of your name that aren't you? This is the number 1 place to spot early signs of identity theft. A strange address could mean someone opened an account in your name. To a lender, conflicting information is a small red flag. It suggests instability or worse, fraud. Make sure every single letter and number in this section is 100% accurate. If it's not, we're marking it for cleanup later. Now we scroll down to the main event, the section that makes or breaks your score. It might be called accounts, trade lines, or credit history. This is the play-by-play of every loan, every credit card, every line of credit you've ever had. Let's dissect an account line by line. You'll see the creditor's name, say Capital One. You'll see the account number, usually partially hidden for security. You'll see the type of account, revolving, which means it's a credit card, or installment, which means it's a loan with a fixed payment, like a car loan or a student loan. Lenders like to see a healthy mix of both. It shows you can handle different kinds of debt responsibly. Next, you'll see a date. Date opened. This is a huge one. This tells the lender the age of your credit history. The longer, the better. An account that's been open and in good standing for 10 years is like a letter of recommendation from a trusted friend. This is why the common advice to close your old credit cards once you pay them off is one of the most destructive financial myths out there. Closing that old card you opened in college erases a huge chunk of your positive history and can make your score drop. Never close your oldest accounts, even if you just use them once a year to buy a pack of gum to keep them active. Now you'll see two of the most important numbers on the entire report: credit limit, or high balance, and current balance. Let's say your credit limit is $10,000 and your current balance is $5,000. This brings us to the second biggest factor in your score: credit utilization. It's a simple ratio: your balance divided by your limit. In this case, 5,000 divided by 10,000 is 50%. To a lender, a person using 50% of their available credit looks like they might be stretched thin, relying on credit to live. It's a sign of risk. The standard advice is to keep your utilization below 30%. But we're not here for standard. We're here to get the absolute best mortgage rate possible. The secret of the 800 Score Club is keeping utilization under 10%. Yes, 10. On that $10,000 card, that means a balance of less than $1,000. The lower, the better. When you get your reports, look at the utilization on every single card. If you see high numbers, you've just found a massive opportunity. Paying down those balances is the fastest way to see a significant jump in your credit score. Keep scrolling through the account details and you'll find the holy grail: your payment history. This is it. This is 35% of your entire FICO score. It will look like a grid of boxes with letters or symbols. Okay, C, or a green checkmark means you paid on time that month. But then you might see a 30, 60, or 90. That's a late payment. That's a dagger to your score. A single 30-day late payment can drop your score by as much as 100 points, and it stays on your report for 7 years. 7 years. It's a long-term wound. As you scan your history, you need to be brutally honest. Are there any late payments? If so, when? How late were they? And most importantly, are they accurate? Did you really pay late? Banks make mistakes. Systems have glitches. If you find a late payment listed that you are certain you paid on time, you've just found a golden ticket. A potential error that we can get removed. Okay, let's move on from the account section. The next part you'll see is public records. This is where the really heavy stuff lives: bankruptcies, foreclosures, tax liens, civil judgments. Having anything in this section is a major red flag for lenders. It's the financial equivalent of a criminal record. Most of these items also stay on your report for 7 to 10 years. If you have something here, don't panic. It doesn't mean you can never get a mortgage, but it does mean our path is going to be more challenging. The most important thing here again is accuracy. Is that tax lien from 10 years ago that you paid off still showing up? Is that bankruptcy from a person with a similar name somehow on your report? It happens more than you think. Finally, you'll see a section for inquiries or credit inquiries. This is where a lot of people get scared. You've probably heard that every time someone checks your credit, your score goes down. That's only half true. There are two types of inquiries: soft and hard. A soft inquiry is when you check your own credit, or when a credit card company pre-approves you for an offer in the mail. These have zero impact on your score. You could have 100 of them and it wouldn't matter. A hard inquiry is what happens when you formally apply for new credit: a credit card, a car loan, a mortgage. A single hard inquiry might ding your score by a few points temporarily. It's a very small piece of the puzzle. But here's the critical part that the fearmongers leave out. When you're rate shopping for a mortgage or a car loan, the FICO scoring models are smart. They know what you're doing. Any mortgage-related inquiries that happen within a 30 to 45-day window are bundled together and treated as a single event. So you can, and absolutely should, shop around with multiple lenders to find the best rate without worrying about trashing your score. Don't let anyone tell you otherwise. So take a deep breath. You have your mission briefing. You know where to get your intel, and you now know how to read it. You know to check your personal info for spies. You know to analyze your accounts for age, utilization, and that all-important payment history. You know to scan for the big bombs in public records and to understand the real story behind inquiries. You have the raw data. You've identified the enemy, the inaccuracies, the high balances, the late payments that are holding your score hostage. You've found the weak spots in the defense. But gathering intelligence is only phase 1. Now comes the fun part. Now we go on the attack. Because knowing what's wrong is one thing. Knowing how to fix it, that changes the game entirely. And that's exactly where we're going next. We're about to turn this information into ammunition. I'm going to show you how to systematically challenge every error, negotiate the removal of negative items, and strategically build a credit history so powerful, lenders will be competing for your business. The reconnaissance is over. It's time to execute the plan. The first move on the chessboard is challenging the inaccuracies. This isn't just sending a hopeful email. This is a legal action you are entitled to under the Fair Credit Reporting Act, or the FCRA. Think of the FCRA as your constitutional right in the world of credit. It states that the information on your credit report must be 100% accurate and verifiable. If it's not, it has to be removed. Period. So where do you start? You take that list of errors you identified during reconnaissance and you attack each one individually. Do not send one giant letter listing 10 different problems. You send one letter for one problem to one bureau. If the same error appears on all 3 reports, you send 3 separate letters, one to Experian, one to Equifax, and one to TransUnion. Why? Because it forces each bureau to open a separate, formal investigation for each individual claim. It prevents them from lumping your issues together and dismissing them with a single generic response. This is a game of overwhelming their system with precision and process. Your weapon of choice is certified mail with the return receipt requested. Disputing online is fast and it's tempting, but it can sometimes mean you inadvertently sign away your right to sue if they fail to correct the error. A physical paper trail is undeniable. It's your proof. So what does this letter, this formal challenge, actually say? It's simple and direct. You're not writing a novel about why the debt isn't yours. You are a lawyer presenting a case. State your name, address, and social security number for identification. Clearly identify the account in question by its name and account number. State unequivocally that the information is inaccurate. You can say something like, "Pursuant to my rights under the Fair Credit Reporting Act, I am writing to dispute the following information in my file. The account from ABC Collections is inaccurate. I have no knowledge of this account, and it is not mine. Please investigate this matter and remove this unverifiable item from my report immediately." Attach a copy of your credit report with the item circled, and a copy of your driver's license and a utility bill to prove your identity. That's it. You send it via certified mail and you wait. The law gives the credit bureaus 30 days to investigate your claim with the creditor who reported the information. If the creditor can't prove the debt is accurate and belongs to you within that window, the bureau is legally obligated to delete it from your report. And you'd be shocked how often old collection agencies can't find the original paperwork or simply don't respond in time. That's a win. You follow this exact process for every single error. Wrong addresses, misspelled names, accounts that aren't yours, late payments that were actually on time. Each one gets its own investigation, its own 30-day clock. But what about the negative marks that are legitimate? The late payment you made on your car loan 2 years ago when you were sick? Or the credit card you missed during a chaotic move? These aren't errors, so you can't dispute them as inaccurate. This is where we shift from a legal assault to a diplomatic mission. We use something called a goodwill letter. A goodwill letter is a polite, professional request to the original creditor, not the credit bureau, asking them to remove a legitimate negative mark as a gesture of, well, goodwill. This works best for isolated incidents on an otherwise good payment history. You're not denying the mistake. You're owning it, explaining it, and asking for forgiveness. The structure is key. First, you state your loyalty and good history with the company. I have been a loyal customer with XYZ Bank for 5 years and have always valued our relationship. Second, you clearly state the problem. I am writing to respectfully request the removal of a 30-day late payment reported from my account in June of 2022. Third, you explain the circumstances without making excuses. This is critical. Don't blame them. Take responsibility. At the time, my family was dealing with a significant medical emergency, and in the chaos, I regrettably overlooked this payment. It was a complete oversight and does not reflect my true commitment to my financial obligations. Fourth, you highlight your positive payment history since the incident. As you can see from my record, since that single instance, every single payment has been made on time, and I've maintained my account in excellent standing. Finally, you make the ask. I am currently in the process of applying for a mortgage to purchase a home for my family, and this single late payment is having a significant negative impact on my credit score. I would be incredibly grateful if you would consider making a goodwill adjustment to remove this mark from my credit report. You send this letter to the creditor's customer service department, and you might have to send it a few times. You might get a no, but you also might get a yes. We've seen this work countless times. Creditors are run by people, and sometimes a sincere, well-written appeal can get a sympathetic manager to make a change that could boost your score by 30, 40, even 50 points. It costs you a stamp and 20 minutes of your time. The potential reward is life-changing. Now, with the errors disputed and the goodwill letters sent, we move to the third and most crucial phase: building your new credit fortress. It's not enough to just remove the negative. You have to actively, aggressively build the positive. Lenders need to see a recent, consistent history of responsible credit management. If you have very little credit or a damaged score, your first step is a secured credit card. This isn't a debit card. It's a real credit card that reports to all 3 credit bureaus. The difference is that you provide a security deposit, usually a few $100s, which becomes your credit limit. So if you deposit $500, you get a $500 credit limit. You use this card for a small, recurring purchase every month, like your Netflix subscription or your gas. Then you pay the bill in full on time every single time, without fail. After 6 to 12 months of this perfect payment history, the bank will often refund your deposit and upgrade you to a regular, unsecured credit card. You've just manufactured a perfect payment history out of thin air. The second tool is a credit builder loan. These are offered by many credit unions and some banks. It sounds strange, but you're essentially borrowing your own money. The bank puts the loan amount, say $1,000, into a locked savings account that you can't touch. You then make small monthly payments on that loan for a set term like 12 months. Each on-time payment is reported to the credit bureaus as a positive mark on an installment loan, which is a key part of your credit mix. At the end of the term, the savings account is unlocked, and you get your $1,000 back. Plus, you've just added 12 months of perfect payment history to your file. The third strategy is becoming an authorized user. If you have a trusted family member, a parent or a spouse, with a long-standing credit card and a perfect payment history, they can add you to their account as an authorized user. You don't even need to have or use the physical card. The entire history of that account, its age, its credit limit, its perfect payment record, gets grafted onto your credit report. This can instantly increase the average age of your credit accounts and lower your overall credit utilization. 2 factors that can provide a massive and immediate boost to your score. A word of caution: make sure the person you choose is financially responsible. Their habits, good or bad, will now be reflected on your report. By executing this 3-pronged strategy, disputing errors, negotiating removals, and building new positive credit, you are fundamentally changing the narrative of your financial life. You are no longer just a number spit out by an algorithm. You are the architect of your own credit profile. You're taking the raw data and sculpting it into a masterpiece of responsibility, a story that proves to any lender that you are a safe bet, that you are worthy of that loan. Your credit score is now climbing. The negative items are vanishing. Your report is beginning to shine with on-time payments and low balances. You've built a powerful foundation. But this is only one half of the equation. A pristine credit score is a key that can unlock the door to a mortgage, but you still need the financial strength to push that door open. Your credit proves you're responsible. Now you have to prove you're able. The next battleground isn't your past. It's your present. It's your income, your assets, and your debt. And we're about to dissect every single dollar to make sure it's counted, categorized, and presented in a way that makes a mortgage underwriter say yes without a second thought. Let's start with the bedrock of your financial life: your income. For a lender, your income isn't just a number. It's a story of stability. It's their primary evidence that you can handle the single largest debt of your life, month after month, year after year. So, how do you tell this story? You tell it with paper. If you're a W-2 employee, meaning you get a regular paycheck from an employer, your story is the most straightforward. The lender wants to see your most recent pay stubs, usually covering a 30-day period. They're looking at your gross pay, your deductions, and your year-to-date earnings. They're confirming that what you claimed on your application matches the reality of what's hitting your bank account. Then they'll ask for your W-2 forms for the last 2 years. Think of your W-2 as the official government-stamped summary of your annual earnings. 2 years of these tells the lender, this isn't a fluke. This person has a consistent earning history. Now what if you just got a big raise? Great. That helps, but a lender won't typically use that brand new salary figure until you have a pay stub reflecting it. What about overtime or bonuses? This is crucial. If you want that extra income to count towards your qualification, you need to prove a 2-year history of receiving it consistently. A one-time Christmas bonus from last year probably won't cut it. They need to see a pattern. The theme here is consistency. A lender would rather see 2 years of a steady, predictable $75,000 salary than 1 year at $50,000 and the last 3 months at $100,000. Stability is king. But what if your income story isn't so simple? What if you're one of the millions of freelancers, gig workers, or small business owners in America? Welcome to what I call the entrepreneur's gauntlet. Your path is harder, and the documentation requirements are far more intense, but don't be discouraged. It just means your story requires more evidence. For you, pay stubs and W-2s don't exist. Your proof is your federal tax returns, all pages, all schedules for the last 2 years. Lenders aren't just looking at your gross revenue. They're looking at your net income after all your business expenses. This brings us to the great paradox for the self-employed. For years, you've probably worked with an accountant to legally write off every possible expense to lower your taxable income. You've written off your car, your home office, your phone, your supplies. And that's smart tax strategy. But when you apply for a mortgage, that strategy can backfire spectacularly. The lender is going to look at the final number on your tax return, the adjusted gross income, and use that or an average of the last 2 years of it to qualify you. So if you made $150,000 in revenue but wrote it all the way down to a taxable income of $40,000, in the eyes of the mortgage world, you make $40,000 a year. Period. It's a painful truth many entrepreneurs discover far too late. The key, if you're planning to buy a home in the next couple of years, is to start strategizing with your accountant to balance tax efficiency with the need to show a higher qualifying income. You may need to consciously pay more in taxes for a year or two to show the bank the income they need to see to give you the loan you want. It's a strategic trade-off. Alongside your tax returns, you'll likely need to provide a year-to-date profit and loss statement, or P&L. And you may need a letter from your CPA confirming your business is active and viable. They are building a case that your business, which might seem unpredictable from the outside, is actually a stable income-generating machine. Okay, so that's the money coming in. Now let's talk about the money you have. These are your assets. This is your down payment, your closing costs, and your reserves, the cash you have left over after the transaction closes. Lenders want to see that you have this money, and just as importantly, they need to know where it came from. This is where your bank statements come in. You'll need to provide the last 2 months of statements for every account you plan to use funds from: checking, savings, money markets, you name it. And the underwriter will scrutinize these statements like a detective at a crime scene. They are looking for one thing in particular: large, unusual deposits. Why? Because they need to ensure the money for your down payment is yours and not some secret, undisclosed loan from a friend that you'll have to pay back. That would be new debt, and it would change your entire financial picture. Every dollar for this transaction must be sourced and seasoned. Seasoned means the money has been sitting in your account for a while, typically at least 60 days. Sourced means if it's new, you have a paper trail to prove its legitimate origin. Let's say your parents graciously gifted you $20,000 for your down payment. You can't just deposit that cash and pretend it was always there. That $20,000 deposit will be a giant red flag for the underwriter. The proper way to handle this is with a gift letter. This is a formal document where your parents state that the money is a true gift, not a loan, and that there is no expectation of repayment. You'll also need to provide a paper trail showing the money leaving their account and entering yours, like a copy of the check and the deposit slip. It feels intrusive, but it's non-negotiable. The same goes for selling a car or a valuable asset. If you sell your old truck for $8,000 in cash to help with closing costs, you'll need a bill of sale and a copy of the title transfer to prove where that $8,000 came from. No paper trail, no money. It's that simple. Remember the rule: every dollar needs a story. Beyond your bank accounts, other assets can play a role too. For 401(k)s, IRAs, stocks, and other investment accounts can be used for your down payment, though you should talk to a financial advisor about the tax implications. More often, these accounts are used to satisfy a lender's requirement for reserves. Reserves are a specific number of months' worth of your new mortgage payment, including taxes and insurance, that you have left in the bank after you close. It's your safety net. Having 2 to 6 months of reserves in an account shows the lender that if you lose your job a month after closing, you won't immediately default. Proves you have a cushion. Finally, there's the other side of the ledger: your debt. The lender is going to see all of your installment loans and revolving credit lines on your credit report, your car loans, student loans, and credit card balances. This is what they use to calculate your debt-to-income ratio, which we've talked about. Your job isn't so much to provide documents for this, but to be ready to explain anything unusual. If you have a loan you're co-signed on for your brother, for example, you may need to provide 12 months of his bank statements to prove he's the one making the payments, so it doesn't count against your debt ratio. What this all boils down to is creating an unimpeachable financial dossier, a complete, logical, and documented history of your financial life. Your income is stable and proven. Your assets are legitimate, sourced, and seasoned. Your debts are transparent and accounted for. You have built a fortress of financial proof, brick by paper brick. Now you have this mountain of documentation, this complete story of your financial life printed out and organized. You have your credit in order. You have your proof of funds. You've done the hard work of preparation. But all the preparation in the world doesn't mean much if you hand it over to the wrong person. You've assembled your financial DNA. Now it's time to find the right scientist to interpret it. Because the person you choose to guide you through this process, your loan officer, can be the difference between a key and a closed door. And choosing the right one is an art form in itself. Think of it this way. You wouldn't let a first-year medical student perform open-heart surgery, so why would you let an inexperienced or ill-suited loan officer handle the single largest financial transaction of your life? This isn't just about finding the lowest interest rate. A great loan officer is a strategist, a problem solver, and a financial therapist all rolled into one. They can see a potential issue 3 weeks down the road and solve it today. A bad one can turn your dream home into a paperwork nightmare that ends in a soul-crushing denial letter. So, where do you find these financial wizards? They exist in 4 main habitats, and understanding the ecosystem of each is critical. First, you have the most visible giants in the jungle, the big national banks. Think Chase, Bank of America, Wells Fargo. The appeal here is familiarity. You might already have your checking account with them, maybe a credit card or a car loan. They're the department store of finance. The potential advantage is a relationship discount. Sometimes, if you're a long-standing customer with significant assets, they might knock a fraction of a % off your rate or reduce some fees. It's convenient, but this convenience can come at a cost. These institutions are like aircraft carriers. Immense, powerful, but incredibly slow to turn. Their underwriting guidelines are often rigid, black and white. If your financial picture has any color in it, maybe you're self-employed, have a unique income structure, or a blip on your credit, you can easily get stuck in their bureaucratic machinery. Getting a human being to make a common-sense exception can feel like trying to petition a king. Next, you have the credit unions. These are the community-focused counterparts to the big banks. They're nonprofits owned by their members, and that fundamental difference in structure often translates to a better experience. Because they're not beholden to shareholders, they can often offer slightly better interest rates and lower fees. Their mission is to serve their members, not to maximize profit. This often means more personalized service and a willingness to look at you as a person, not just a file number. The catch? You have to be a member. Membership can be based on your employer, your profession, where you live, or even a family member's affiliation. If you qualify, they are absolutely worth exploring. The potential downside is that they might not have the same breadth of loan products as a massive bank, and sometimes their technology can be a step or two behind the curve. Then we have the new titans of the industry, the direct online lenders. Companies like Rocket Mortgage or Better.com. Their entire model is built on speed, efficiency, and a slick user interface. You can apply for a mortgage in your pajamas at 2 in the morning. Their automated systems can process vast amounts of data in seconds, often giving you a pre-approval almost instantly. Because they have lower overhead, no fancy brick-and-mortar branches, they can be incredibly competitive on rates and fees. For someone with a straightforward W-2 job, great credit, and a simple financial profile, this can be a fantastic frictionless path to a mortgage. But what happens when things aren't simple? The algorithm is king, and if your situation doesn't fit neatly into its pre-programmed boxes, you can find yourself in a customer service labyrinth. You might talk to a different person every time you call, explaining your story over and over again. These are the high-speed bullet trains of the mortgage world. Unbelievably fast and efficient for a straight shot on a clear track. But if there's a problem, the whole system can come to a grinding halt. Finally, we have the fourth and perhaps most misunderstood option, the mortgage broker. A broker is not a lender. This is the most important distinction to understand. A broker is your personal mortgage shopper. They are an independent agent who has relationships with dozens of different wholesale lenders. Lenders you've probably never heard of, because they don't advertise to the public. You fill out one application, and your broker then shops your specific financial profile to all of these different lenders to find the absolute best fit for your situation, not just in terms of rate but in terms of underwriting guidelines. Think about it. One lender might be great for veterans, another might specialize in loans for self-employed borrowers, and a third might have a special program for buyers with a lower down payment. You would never know this on your own. A good broker does. Their loyalty isn't to one specific bank. Their loyalty is to you and to getting the deal closed. They are the ultimate strategists. If one lender says no, they don't just give up. They repackage your file and take it to another lender who they know is more likely to say yes. They are the secret weapon for anyone with a complex financial story. So how do you choose? You interview them. Yes, you are the one in charge here. You are hiring someone for a very important job. You should approach it with the same seriousness as hiring a key employee. Whether you're talking to a loan officer at a big bank, a credit union, or a mortgage broker, you need to ask the right questions. Start with this. How long have you been in the business, and how many loans did you personally close last year? You're looking for experience in recent, relevant activity. Someone who closed 50 or 100 loans last year has seen almost everything. They've navigated the last-minute emergencies and know how to solve problems. Next, ask, based on my situation, what specific loan programs do you think would be the best fit, and why? This tests their knowledge. A great loan officer won't just quote you a rate for a 30-year fixed. They'll listen to your goals. Are you planning to stay in the home for 5 years or 30? Is your income likely to increase significantly in the near future? They should be able to explain the pros and cons of different options, like an FHA loan versus a conventional one, or whether an adjustable rate mortgage might actually make sense for you. Then the critical question. What is your communication process, and who will be my main point of contact throughout the loan? This is huge. The mortgage process is stressful. Radio silence is torture. You want to know if they will provide weekly updates. Will you be speaking directly to them, or will you be handed off to a junior processor or an assistant after the application is signed? You need a single accountable point person who knows your file inside and out. And now, for the million-dollar question. This is the one that separates the true professionals from the mere salespeople. Ask them this. Looking at my financial profile, what potential red flags or roadblocks do you foresee? And what is your specific plan to address them? A rookie or a lazy loan officer will say, "Oh, everything looks great. No problems here." An experienced veteran will say, "Okay, I see you had a late payment on a credit card 18 months ago. The automated underwriting system might flag that. Here's how we're going to address it up front with a letter of explanation. I also see you're using some gift funds for the down payment. We need to make sure we source that money correctly with a proper gift letter and paper trail right now, so it doesn't become a problem a week before closing." That is the person you want on your team, the one who sees the storm coming and builds the ark before it starts to rain. Finally, be wary of red flags. If a loan officer guarantees you a specific rate before they've seen a single piece of your documentation, run. That's a bait-and-switch tactic. If they are slow to respond to your initial inquiry, imagine how slow they'll be when they actually have your business and a real fire needs to be put out. If they use high-pressure tactics or can't explain complex terms in a simple way you can understand, they are not your guide. They are a liability. Choosing your loan officer is choosing your advocate. You're not just looking for a number cruncher. You're looking for a partner who will fight for you. They are the translator between your life story, told through tax returns and bank statements, and the rigid, unforgiving language of the underwriting guidelines. Once you've found that champion, that expert guide you can trust, you're ready to take the next step. You're ready to formally apply and step into the arena. This is where the real scrutiny begins, a process called underwriting. It's a deep-sea dive into every corner of your financial life. And it's where most deals either solidify or fall apart. The underwriter is the final gatekeeper. They are not a salesperson. They have no emotional investment in your dream of homeownership. Their one and only job is to protect the lender's money. They are a financial detective, a risk analyst, and the ultimate decision maker, working from a thick file of your documents, looking for one thing: reasons to say no. Their process is methodical, exhaustive, and guided by a framework you need to understand. Often called the 4 C's of credit: capacity, capital, credit, and collateral. Let's start with capacity. This is the raw math. Can you actually handle this monthly payment plus taxes plus insurance for the next 30 years? The underwriter goes back to your debt-to-income ratio, but this time they're not just taking your word for it. They are verifying every single number with a fine-tooth comb. They will call your employer, sometimes multiple times, to conduct a verbal verification of employment. They'll confirm your start date, your title, your salary, and most importantly, your likelihood of continued employment. If you get a promotion or a raise during this process, that's great, but you'll need to provide all the new paperwork to prove it. If you change jobs, that's a massive red flag that could derail the entire loan. Even if it's for more money, lenders crave stability above all else. For the self-employed, this scrutiny is magnified tenfold. The underwriter will dissect at least 2 years of your business and personal tax returns, looking at your gross income, your write-offs, and the overall health and consistency of your business. They want to see a stable, predictable pattern of income, not a wild roller coaster. One great year followed by a bad one is far less attractive than 2 solid, average years. Your capacity isn't just about what you earn today. It's about the underwriter's confidence that you will continue to earn it for the foreseeable future. Next, they analyze your capital. This is your skin in the game. It's the cash you have on hand for the down payment, the closing costs, and the reserves, the extra funds the lender wants to see left over in your account after you close. They want to see that you can survive a financial emergency, like a job loss or a major repair, without immediately defaulting on the mortgage. But here's the critical part. They need to know where every single dollar came from. This is called sourcing and seasoning your funds. Seasoning means the money has been sitting in your account for a while, typically at least 60 days, proven by 2 full months of bank statements. Why? Because it shows the money is truly yours, not a last-minute, unrepayable loan from a friend that's really just more debt in disguise. Any large, unusual deposit that isn't from your regular paycheck will be questioned. A $50,000 deposit that suddenly appears a month before closing? You will have to provide a full paper trail explaining exactly where it came from. If it was a gift from a family member, you'll need a formal gift letter, signed by the donor, explicitly stating that the money is a gift and not a loan that needs to be repaid. You'll also need proof of the transfer from their account to yours. If you sold a car, you'll need the bill of sale. If you cashed out stocks, you'll need the brokerage statements. The underwriter's mantra is, if it can't be documented, it doesn't exist. They are building a case that you are a responsible, reliable borrower, and unexplained cash torpedoes that case. Third is credit. Yes, they've already pulled your credit report and seen your score. But the underwriter isn't just looking at the 3-digit number. They are reading the entire story of your financial life. They'll scrutinize every account, every payment history, every inquiry. Have you opened any new credit cards since your pre-approval? Did you finance a new car or a living room full of furniture? This is the absolute worst thing you can do during underwriting. A new loan or credit card immediately changes your debt-to-income ratio and signals potential financial instability. It forces the underwriter to completely reevaluate your file. They'll also look for discrepancies. Does the address on your credit report match your application? Are there any cosign loans you forgot to mention? Any old, forgotten collections accounts that have suddenly popped up? They will demand a letter of explanation for any late payments or derogatory marks on your record. You'll have to write out in your own words why it happened and why it won't happen again. They are looking for patterns of behavior. A single, well-explained late payment from 5 years ago is one thing. A consistent pattern of missed payments is a deal killer. Your credit score got you in the door. Your credit history is what the underwriter uses to judge your character as a borrower. Finally, and just as important as your own finances, is the collateral. This is the house itself. The lender is about to give you hundreds of thousands of dollars, and they need to be absolutely certain that the asset they're securing the loan against is actually worth that much. This is where the appraisal comes in. The lender will order an appraisal from a licensed, third-party appraiser who has no connection to you, the seller, or the real estate agents. Their job is to provide an unbiased, professional opinion of the property's fair market value. They'll visit the home, measure it, note its condition, and compare it to at least 3 similar homes, known as comps, that have recently sold in the immediate area. The final appraisal report is sent directly to the underwriter. If the appraised value is equal to or higher than your offer price, everyone breathes a sigh of relief. But if the appraisal comes in low, you have a problem. The bank will only lend you an amount based on the appraised value, not your higher offer price. Let's say you offered $400,000, but the appraisal comes in at $380,000. You now have a $20,000 gap. You have three options. You can try to renegotiate the price with the seller, you can pay the $20,000 difference in cash out of your own pocket, or if your contract allows, you can walk away from the deal entirely. Alongside the appraisal, the underwriter will also review the title search. A title company scours public records to make sure the seller has the legal right to sell the property, and that there are no hidden claims, liens from unpaid contractors, or outstanding property taxes against it. This ensures the lender has a clean and primary claim on the property if you default. After the underwriter has examined all 4 C's, your capacity to pay, the capital you've saved, your creditworthiness, and the value of the collateral, they will make a decision. Rarely is it an immediate yes. More often than not, the first response is a conditional approval. This is a huge milestone. It means the underwriter is willing to approve the loan if you can satisfy a list of remaining conditions. These conditions are requests for more information or documentation. It could be a final updated pay stub. It might be a letter explaining a recent credit inquiry. It could be proof that you've paid off a specific credit card. You and your loan officer will work to gather every last document on this list and submit it back to the underwriter. Once every single condition has been met to their satisfaction, you will finally receive the 3 most beautiful words in the entire home buying process: clear to close. This is the official green light. The underwriter has signed off. The lender has committed the funds. The finish line is in sight. All the stress, the paperwork, the waiting, it all leads to this moment. The only thing left is to show up, sign your name on a mountain of documents, and finally, get the keys to your new home. This is called closing, or sometimes settlement, and it's the final formal step in the entire journey. It's where you sign the last of the paperwork, hand over the last of the money, and the seller officially transfers ownership of the property to you. You'll walk into a room, likely at a title company or an attorney's office, and you'll see a stack of paper on the table that looks thick enough to stop a bullet. Don't panic. We've come too far to panic now. The main person you'll be dealing with is the closing agent. This is a neutral third party whose job is to make sure every document is signed, every dollar is accounted for, and that the title to the home is transferred legally and correctly. Your real estate agent will be there for support, and sometimes the seller and their agent are there too, though in many cases they sign their documents separately. The first thing you'll do is provide your photo ID and the funds for your closing costs and down payment. This isn't a personal check situation. You'll need a cashier's check, or more commonly these days, you'll have already wired the money. Seeing that number leave your bank account is a uniquely terrifying and exhilarating moment. It's the point of no return. Then the signing begins. The closing agent will walk you through the stack, document by document. You're going to feel an immense pressure to just sign and get it over with, but take a breath. You have the right to read and understand what you're signing. 3 documents in this stack are the true heavyweights. First is the final closing disclosure, or CD. You saw a preliminary version of this 3 days ago. This is the final official breakdown of every single cent involved in the transaction. Your loan amount, interest rate, monthly payment, and the exact amount of cash you needed to bring to the table. You'll compare it to the one you already reviewed to make sure nothing has changed unexpectedly. You'll sign it, acknowledging that you understand the final terms of the deal. Next comes the promissory note. This document is exactly what it sounds like. It's your promise. It's the you to the lender. It states that you promise to repay the loan, and it details the amount, the interest rate, and the schedule of payments. When you sign this, you are personally on the hook for hundreds of thousands of dollars. It's a simple document, but it carries immense weight. The third titan of paperwork is either the mortgage or the deed of trust, depending on your state. These 2 documents do essentially the same thing. They secure the promissory note. They are the legal instrument that gives the lender a security interest in your property. It's the or else document. It says, I've signed the promissory note promising to pay, and if I fail to do that, the lender has the right to foreclose on and take this house to get their money back. This is the document that ties the loan directly to the real estate. You'll sign dozens of other papers, tax forms, title documents, affidavits stating you're not a foreign spy buying property for nefarious purposes. Okay, maybe not that last one, but it feels like it. Your hand will start to cramp. Your signature will devolve into an illegible scribble. And then suddenly it's over. The closing agent will gather up the signed copies. The funds will be disbursed, the seller gets their money, the agents get their commissions, the old mortgage is paid off. And then, the moment it was all for, someone, usually the seller's agent, will slide a set of keys across the table. They're yours. They might be on a simple metal ring or a fancy real estate company keychain, but it doesn't matter. They are the keys to your front door. The feeling is indescribable. It's a cocktail of relief, exhaustion, pride, and a little bit of terror. You did it. You own a home. But the journey isn't quite over. Owning a home isn't a destination. It's the start of a new chapter with its own set of responsibilities. Your first mortgage payment, for instance, can be a little confusing. You likely prepaid interest for the remaining days of the month at closing. So your first full payment won't be due on the first of the very next month. Usually you skip a month. If you close in May, your first payment will likely be on July 1st. Your lender will send you a statement well in advance, detailing exactly how and when to pay. Set this up for auto-pay immediately. Don't risk a late payment on day one. Remember that escrow account we set up? Your monthly payment includes principal, interest, taxes, and insurance. Pity. The lender holds the T and I parts in escrow and pays your property tax and homeowner's insurance bills for you when they're due. Here's the key thing to remember. Those bills can change. Your property taxes can go up. Your insurance premiums can increase. When that happens, your lender will conduct an escrow analysis and adjust your monthly payment to cover the new, higher costs. So that payment you sign for at closing? It's not set in stone for 30 years. Be prepared for it to fluctuate. Now for a piece of advice that can save you thousands of dollars over the life of your loan. As soon as you close, file for your homestead exemption. This is a legal provision in many states that can reduce the amount of property tax you owe on your primary residence. It's not automatic. You have to apply for it with your local county tax office. The deadline and rules vary by state, so Google homestead exemption for your county the day you move in and get it done. It is free money you're leaving on the table if you don't. Finally, a word of warning. The moment that deed is recorded with the county, your name and new address become public record. Within weeks, your mailbox will be flooded with junk mail that looks deceptively official. You'll get letters about mortgage protection insurance, offers to get a certified copy of your deed for an exorbitant fee, and other official-looking documents that are, in reality, just cleverly disguised sales pitches or scams. The only company you need to deal with regarding your mortgage is the lender or servicer, who sends you your official monthly statement. Shred everything else. Looking back, the path to this moment can seem impossibly complex. It started with a dream, a simple desire for a place to call your own. That dream led to the practical, sometimes painful process of saving money and building your credit. It led to finding a great agent, getting that all-important pre-approval letter, and stepping into the battlefield of house hunting. You found the one, you made an offer, you negotiated, and you went under contract. Then came the deep dive. The inspection, the appraisal, and the endless, nerve-wracking scrutiny of underwriting, where your entire financial life was placed under a microscope. And finally, you made it through the clear to close, to the closing table, and to the moment you held those keys in your hand. Each step is a hurdle, a checkpoint designed to ensure that this massive financial decision is sound for both you and the lender. It's a system built over decades, filled with jargon and paperwork, but it's not magic. It's just a process. And by understanding it, by taking it one step at a time, you strip it of its power to intimidate you. You transform it from an overwhelming obstacle into a manageable checklist. Getting a mortgage in America is more than a financial transaction. For many, it's a rite of passage. It's the moment you put down roots. It's the foundation upon which you build equity, create stability, and make a space in the world that is truly, unequivocally yours. It is difficult. It is stressful. But it is absolutely achievable. If this series has helped demystify that process for you, do me a favor and hit that like button and subscribe for more content that breaks down complex financial topics. It tells the algorithm that this is valuable information, and it helps more people just like you find the answers they're looking for. What was the most surprising part of the mortgage process you learned about? Let me know down in the comments. Thank you for coming on this journey. Congratulations on taking the first, most important step, seeking knowledge. Now go build your future.